Okay, it's 5:03, right? And we'll start promptly on time today, right? Welcome to today's session on dividend investing, right? It's a very, very popular topic, as what we know, right, from our clients. And I have here two very special speakers with us here today. We don't usually see them, so it's going to be a very interesting session, right? So without further ado, let me just introduce our two speakers. Right, so first up we have Samantha Horton, right, or as she likes to be known as Sam, right. So she used to cover Singapore banks as well, right, and she actually managed a global consumer portfolio before Syfe, right. So right now she's actually the Chief Business Officer here at Syfe, right. And a fun fact, as part of her discipline, she wakes up very early, almost on a daily basis to actually exercise. So if you are exercising early in the morning, feel free to just message her. All right, I can't do it personally. All right. So next up, we have Richaard, co-founder of WealthEnjoy. Right, he helps to manage several communities, trading communities online, investor communities online as well. Right. So based on my conversations with him, this is one of the rare video appearances. Right. If you have heard him speak, you will know what I'm talking about. Right, but he is a very avid student of the market, so we are very privileged to have him here with us today, right? So some quick poll itself. All right, I know it says poll results, but can we just share the poll here? All right, so we have two poll questions, right, just to get a general feel of how our investors are looking at the current market. So first question, how are you currently generating passive income? And the second question, what is your target monthly earning from passive income? Is it going to be below 1K, 1 to 5,000, 5 to 10,000, or you are aiming for more than 10,000 even? All right. So maybe Sam, do you want to just chime in and share what's your targeted monthly earnings from passive income?
Well, I think you always have to target high, so above 10,000, of course.
Most of them. I will agree. I would agree. How about Richaard? How are you currently generating passive income, or is that too soon? Am I jumping the gun over here?
Jumping the gun, but of course as high as possible. When your passive income exceed your expenses, that's when you have financial freedom, right?
All right, well said, well said. All right. Okay, let's see how are the poll results. All right. Can we go to the poll results, please, Desiree? Okay. No worries. Let's see. All right. So here are the results. Okay, here are the results. I'm sure everybody can see on their screen right now. Right. So wow, 85% of our viewers today are dividend focused or fixed income portfolios. Right, and their targeted monthly earnings is 1 to 5K. Wow, that's much lower than what you're looking at, Sam. All right. Okay, so anyway, that's just a quick side to today's topic. Right. Before I hand the time over to our speakers, this is for the benefit of those who are joining us here for the first time today. Right. So a little bit about Syfe. We're actually a digital investment platform. Right, we are headquartered here in Singapore, right, and we actually have a MAS license. Right, our mission is to actually empower people to build their wealth for a better future, right, and the four individuals that you see over here, they're actually a testimony to this statement itself. So here you do see the Syfe Wealth as well as the Syfe Trade platform, right, both different platforms, but they are accessible via a single mobile app itself. So this allows our clients to actually approach their investments in a very holistic manner, right? It really does make it a lot more seamless in terms of the whole user experience. Okay, this here is one of my favorite slides. It actually showcases how much of a priority that we place safety upon. Right, so Syfe is regulated under MAS, like I mentioned earlier. So we have a CMS license, right? And part of this means that our clients' funds are always held in a separate trust account, separated away from our company's operational funds itself. Right? So clients can have that peace of mind when they actually invest via Syfe itself. All right, so brief introduction about Syfe. I'm sure there's a lot we have to unpack today. I'll just pass the time over to Sam. Sam, please.
Great. Thanks very much, Jason, and super excited to be here with Richaard. Again, he tells me the last time we were on a webinar together was about a year ago. So time flies when you're having fun. So maybe we can go to the next slide, Jason. So just before we go into, obviously, listening to Richaard tell us more about how to invest for dividend income with Singapore banks, right? Wanted to perhaps paint a little bit more of the picture in terms of some of the various other options and ways in which you can achieve passive income and generate yield, right? So within the Syfe platform itself, we have a number of options. And firstly, being our Cash Plus product, which is a cash management solution, invest in short-term money market funds and short duration bonds, and is currently yielding 3.4%. And this is continued to move up with interest rates as central banks around the world continue to raise rates to deal with inflation, right? So this for this solution, it is a very stable product, and over the last year and a half, it has not had any monthly negative returns, right? So this is for if you're looking for stable income, a much more product which you can go in and out of, right, for your cash liquidity needs, but still earn yield. And then we move more to the investment side. We have our REIT Plus offering, which is a very popular offering on our platform. This portfolio tracks the S-REIT Leaders Index, and essentially is for investors who want some property exposure and are looking for potential capital appreciation as well as yield. And is a perhaps a good comparison and diversification for what Richaard is going to cover more on in terms of Singapore banks later. So the current yield on this portfolio, for your reference, is 5.8%, so very attractive right now. Also, one advantage of this portfolio is that we reinvest your dividends, and there is no transaction fees, right? So and no minimums. So also a very flexible portfolio. And then, of course, where we go to our trade platform, as Jason mentioned. So from the fully managed wealth side into the self-directed trade or brokerage platform of Syfe. And here we have access to US and Singapore stocks and ETFs. And this is where you can access the Singapore bank stocks that Richaard is going to be speaking about later. And finally, another very exciting announcement that we are going to have later this month, but I will tease it a little bit now, that to really round out our passive income and yield offering, particularly given how popular we know that this theme is right now, as again rates go up and the yield products are becoming even more attractive. We will soon have another exciting product to offer our clients, which will be more on the wealth side, and I won't say too much about that, but please stay tuned for later this month. Okay, I think we are ready for Richaard to take over.
All right, thank you. Thank you, Sam. I'm also very excited about the new yield product from Syfe. Yes, okay, can see my screen? Can see my slides? Jason, can see my slides?
Yep, we can.
Okay, wonderful. Thank you. Yes, wow, yes, as Sam has said, it's almost a year since we last had a webinar here. And thanks, Syfe, for inviting me again to speak and to share some of my learnings that I have done over the years, right? So these are a little intro about me. So Jason have already done that. Okay. And for those of you who are new to me, and if you'd like to find out more about what I do and some of the webinars and seminars that I'm conducting with other gurus in the space, please join the WealthEnjoy Telegram channel. You just have to search for WealthEnjoy in Telegram and join it. It is a channel, not a group chat, so it will not be noisy. And this is my favorite slide, the disclaimer. All right, this webinar is intended solely to provide general information only and is not an offer to sell to any person or a solicitation from any person of an offer to buy any securities. The information in the webinar is for educational purposes only. It is not intended to be, nor should it be construed as investment advice. And before making any investment decisions, you need to consider with your financial advisor your particular investment needs, objectives, and circumstances. And any references to specific securities are meant to illustrate certain concepts and neither intended nor to be construed as recommendation or advice to buy any specific security. Okay, so if you would like to study deep into the disclaimer, please pause the video. All right, so today's topic is very interesting and is one of my favorite topics, and that is on dividend investing, and specifically how to build a passive income portfolio from using Singapore banks and doing this amidst the global bank crisis. Now that is a mouthful, isn't it? So let's dive it right in, okay? So today's session will be where I will be sharing about dividend investing, how to analyze the price charts for entries, and how to build a Singapore bank dividend portfolio. I'll be sharing 2 models for your consideration on how to do that. Just a quick reminder, this is not financial advice and I am not licensed to give advice. Now, please do your own due diligence and homework. As there's a lot of content to cover today, not to worry. Do watch a recording that will be uploaded to Syfe YouTube as well as WealthEnjoy YouTube, because I'll be going fairly quickly. First, dividend investing. So why do we want to consider dividend investing? Now, to me, there is only one reason, and that is for passive income. Having capital gain would be a bonus. And to understand dividend investing, the first concept that we need to understand is dividend yield. So to understand dividend yield, we need to understand what is dividend. Dividend is basically the amount that is paid by the business to shareholders on a regular basis, typically a 3-month or a quarterly basis or half-yearly basis. And the other term that we need to understand is DPS, which stands for dividend per share, which is the amount that is per share that is paid to shareholders. Now, how do we calculate dividend yield? It is this very simple formula. DPS, which is dividend per share, divided by price, which is the share price. Now, to dive deeper, let me illustrate. Now, if we are talking about 2,000 shares of a particular company X, and this company X have paid in the last 12 months $1,000 of dividend to you, and you hold 2,000 shares. So the DPS, dividend per share, that has been paid to you in the last 12 months would be taking the $1,000 that you receive, divide by the number of shares that you have, and that will give you 50 cents. 1,000 divided by 2,000. And if the price today is $10, company X stock price is $10, then your yield would be DPS, which is 50 cents, divided by the stock price, which is $10, giving you a yield of 5%. Now, this is commonly known as the current yield. This is very important, all right? People talk about yield, are they talking about the current yield or another type of yield that I will review shortly? So current yield basically means that it is the DPS TTM, and TTM stands for trailing 12 months, which means that in the last 12 months that you have received, divided by the current price, thus giving you the current yield. So to illustrate, if today the price of the business is $5 and your DPS is 50 cents, then it will be giving you a current yield of 10%, because 50 cents divided by $5 is 10%. But if the price of X company is $15 today, then your current yield would be 50 cents divided by $15, giving you a current yield of 3.3% if you bought the company X share price for $15. Now, this is the other type of yield that I am talking about. It is called yield on cost, or YOC for short. The formula is also very similar to current yield, basically taking the same DPS TTM, divide by the cost of the shares that you have paid previously, right? So it is not taking today's stock price. It is not about you buying the stock today. It's about how much have you paid? How much did you pay for your shares in the past? So that's your cost, right? So taking the last 12 months dividend per share, divide by your cost, which you may have bought the stock 10 years ago, 15 years ago, or 5 years ago, all right? So this is called yield on cost. Now, again, to give you an example, if you are holding 2,000 shares of company X and the company X have paid you $1,000 of dividend in the last 12 months, then the DPS is the same 50 cents as our earlier example. However, if you have bought company X shares for only $2 10 years ago, then your yield on your cost, your YOC, will be taking the 50 cents that you have collected per share for the last 12 months, divide by your cost, which is $2, not today's price, giving you a YOC of 25%. Now, this is very, very important. YOC, okay? Yield on your cost, and 25% is incredible. All right. So if you were to if your friend were to buy the same stock company X today, and assuming the price is $10 today, then the current yield for him would be 5% because it's taking 50 cents divided by $10, the current price. Okay, so between the current yield and yield on cost, which is more important? Okay, so to me, what is more important is the yield on cost, because your yield on cost can grow over the years, right? Provided you bought it cheap, right? Bought it at a lower price. And that's what I hope to be able to share with you, how you could do that using the models I'll be sharing later. All right, so the next topic is why dividend investing in Singapore banks, right? So to me, there are three main reasons. Firstly, Singapore is the financial hub of Asia, and we have very strong regulations here in Singapore. And the Singapore banks that are too important to fail, right? So, for example, where do you put the bulk of your money? Which bank do you bank with, right? So I believe many of you would have some of your wealth with the big Singapore banks in Singapore, right? So in essence, it is about trust and confidence in Singapore as a financial hub, and in Singapore MAS, the government and the banks to give us the confidence to put our money with them. So this is an article from today's Business Times, and MAS have came out to say, actually Minister Tharman have came out to say that the MAS stands ready to provide liquidity in times of global stress. You can search online for this article and you can see, after reading this article, does it give you confidence about Singapore banks and trust in them? Okay, so this is what I'm talking about. So another three reasons of why I like Singapore banks is because the three Singapore banks are the three biggest listed company in the Singapore Stock Exchange. The three companies occupy 46%, almost half of the 30 stocks in the STI index. The other balance of 27 companies occupy the other half. So you can see that these three banks are very big, right? And very important to the Singapore economy. Also, the second reason here is the capital gain and the dividend that we receive are generally tax-free, right? So, and this is a very important benefit. For example, dividend investments in the US stocks are not tax-free. 30% is taken before the balance is given to you if we were to receive dividends from US stocks. So bear that in mind. So Singapore government has given us a very nice benefit, which is tax-free. And also, the banks are able to generate a very predictable revenue and growth because it is a very easy to understand business. Now, to me, banks take our money and then they lend it to someone else at a higher interest rate and then giving us a lower interest rate, and then they make the difference. That's all there is to it. Of course, there are a lot of other compliance things that they need to juggle. But in essence, that's what banking is, right? Simple to understand business. And I like businesses that I can understand. Now, the next point is why now? Why invest now? Well, to do that, to share why invest now, I'd like to borrow these Chinese words called 危机. 危机 in Chinese is a combination of crisis and opportunity. And to me, 危机 means in crisis, it creates opportunities. And now we have a global global banking crisis. Many people are worried about the banks, right? It started off from US, it went over to Swiss, and who knows where else, right? So how about Singapore? Blow in, blow, right? So, but MAS have came out to say that they are willing to provide the liquidity to support the banking system here in Singapore. So there is a banking crisis at the moment, and that creates an opportunity. So who else likes this kind of crisis, right? It will be Warren Buffett, because he said that we need to be greedy when others are fearful. So right now, there's a lot of fear about the banks, right? So therefore, we need to be greedy, all right? So what is the most recent crisis that we have encountered? And I believe that will be the COVID crisis back in March. And I've highlighted in red the 23rd of March 2020, and the stock price of the three banks that we have in Singapore on the 23rd of March 2020. Now, for those who follow the market, you will know that that is the exact bottom of the stock market in US, right? So at that price that you see on the screen, compared to the 31st of March this year, you will see that DBS have increased from $19 to $33. For OCBC have increased from $9 to $12, and for UOB have increased from $20 to $29. Now that is a staggering 71% capital gain from DBS, 36% from OCBC, and 48% from UOB. This is not crypto, this is banks borrowing dividend stocks, and such kind of capital gain is possible. But like I said, this is provided you dare to be greedy when others are fearful. In the midst of the COVID crisis, do we have that kind of guts to do it? Okay, so if we bring it to current time today, with the banking crisis happening elsewhere in the world, do we have the confidence to pull the trigger to buy Singapore banks, right? So to each his own, you need to gauge your own risk appetite and allocate accordingly, because still can lose money, okay? Which then brings me to the next part, which is to do your homework. Now, what homework exactly do I mean for Singapore banks? Now, those of you who are just starting out, you may want to go to the syfe.com website, click on the link in the menu, and then select magazine. And in the magazine, you can click the search icon and type in the word Singapore bank stocks, because Syfe have written a very concise article on how to evaluate Singapore banks, right? Which is this article you see on the screen. Now, in this article that Syfe have written, they have highlighted 4 metrics that you need to look into when evaluating Singapore banks, or any banks for that matter. They are the net interest margin, NIM, the net profit, the return on equity, ROE, and the non-performing loan, NPL. To learn more about these terms, you can Google and go and read up on what Syfe have written about these 4 factors. Also, you should go and read up on the investors relations on the bank's website, so that you can get to know these banks better by reading up on their recent quarterly, half-yearly, or annual reports, their CEO's presentation, their CFO's presentation, and some of them even include a webcast that you can watch, right? And also, you can look at Syfe app, but you need to switch over to Syfe Trade, not Syfe Wealth. And that's where you can create a watch list, like what I did here. I created a SG Bank's watch list so that I can monitor the Singapore bank prices. And then you can also see, if you tap on one of the bank's name, you can see the overview where you can see some important information, such as the 12 months dividend yield. 12 months dividend yield also means the yield based on the last 12 months, TTM. All right. So you can see the 3 banks dividend yield updated daily here. In addition to that, Syfe Wealth, if you switch over to the analysis tab, you can see how many analysts are recommending a buy, overweight, hold, underweight, or sell. All right. You can also see that based on all these experts, what are their thoughts on the current on their prices, their target prices on the high, average, and the low side compared to the current price, so that you can have an idea of whether the current price is undervalued or not. Also, if you switch over to the news tab, Syfe have compiled all the news related to the specific counter that you're looking at, and in this case is DBS, so that you don't have to hunt around to look for the news about the banks that you're interested in. Right? So from those sources, I have compiled this report book or report card about the Singapore banks. The information that I captured are the 4 important metrics: the NIM, net interest margin, the net profit, the return on equity, and the NPL, non-performing loan, from the financials reports of the banks. And also 3 important numbers that I look at, which is the market cap. I want to know how big they are, who is the biggest. I want to know what's their current yield and what is their stock price. Now you will see that there are different colors here. For each of the metric, I like to grade them ABC, just like a report book of your kid, right? So for those who score A, I will give them green star, green color. For those that score B, I will give them white. And those who score C, I will give them red. So you can see at a glance who have the most green and who have the most red. So this is like looking at your class, if you're a teacher, who are the best top student and who is the top 3 students. Okay. So to me, well, depending on your preference, right? So you can, if you're only going to choose one, then you might want to consider choosing the top student. Or maybe you think that the underdog can have a better chance of becoming the top, then maybe you can choose the 3rd position, right? So it's up to you. Or if you feel that, I can't choose, very hard to choose, I want to get them all, then the composition of, or the scores, the report book of your, the businesses that you're buying, the banks that you're buying, all right? So this information...
I have a question, sorry for you, Richard. I have a question for you here, related to how much do you pay attention to the absolute numbers versus perhaps the trend, right? So you're obviously seeing on your chart here, you have DBS's net interest margins is 1.75, but up from 1.45. So how much do you put weightage towards the trend that they're showing versus the absolute numbers?
Very good point. Thanks for asking, Sam. The trend is important, right? The trend lets you know whether this is an outlier or there's something suddenly, a one-time benefit that the bank have received, or there is a one-time hit that the bank have taken. So I do consider the trend. Yeah, but at a snapshot basis, it's like looking at a snapshot basis, when I compare across the 3 banks, then I'll be comparing the absolute numbers. But on an individual bank basis, let's say I'm just looking at DBS, how has DBS performed in the last whatever period, 5 years, 10 years, then I would like to look at the trend. Yep. I hope that answers the question, Sam.
Yeah, sure. Thanks for that, Richard, and go ahead.
No problem. All right, so let me move on. So this is the report card, okay? So we'll come back to this later on. Now, moving on. So I've covered why dividend investing in Singapore banks. Next is how can we buy at a cheaper price, right? So I can tell you, it's impossible to time the lowest point in the market. Impossible. Anyone who tell you they can do it is, to me, lying, right? But at least you can try to identify low points in which the price is low relative to the recent history. Okay, so I'll share with you exactly how you can do that using technical analysis to identify what I call the swing low. And the tool that I'll be using is TradingView. It is a free tool that you can just go online and analyze stock prices there, stock charts there. Now, in this section, I'll be sharing with you how I use TA to identify the swing lows. And using the swing lows is where we will classify whether the candle, that means on the price chart, whether it is considered a signal candle or an entry candle. And I said earlier, TA, technical analysis, does not work 100% of the time. So just bear that in mind. The two indicators that I like to use are stochastic and MACD. The settings are on the screen, and I've actually went into quite a bit of details about how to use it in my previous webinar with Syfe. So you can look for it under Syfe or WealthEnjoy's YouTube channel under the topic of simple technical analysis for long-term stock investing. All right, so I won't go into the details here. If you want to read up on them, feel free to Google or go to school.stockcharts.com, and there's a description on how these indicators are used. If you have added these indicators to your chart, then your chart will look like this. This is a chart of DBS. It is a weekly chart, right? So it's important that we are using a weekly chart. And in the middle section here is the stochastic 933, and the bottom one is MACD. So how do we use it? Now, to identify swing low, we need two conditions to be met on a weekly chart. So what are the two conditions? The first condition is MACD need to be, and the signal line needs to be both below 0. Now you'll see vertical lines here on the chart. On this weekly chart, you can see here, 1W means weekly. If it's not 1W, please click on W here to switch it to weekly chart. Okay, so MACD is the indicator at the bottom. I have boxed up areas where both the MACD and the signal lines are below 0. Okay, so there are 4 areas here. Okay, so that's the first condition. Now the second condition that needs to be simultaneously met is that the stochastic need to go under 20 and then it hook up. So I will use this highlighted box area. I selected this period to showcase to you, to illustrate to you what exactly do I mean by stochastic under 20 then hook up. Okay, so we zoom in already. The two horizontal vertical lines are here. So in this period, we have 3 arrows here pointing to the stochastic, where we see that the stochastic have dropped below 20. This horizontal line, blue area is 20. It dropped below and it keep dropping. And at some point in time, it hooked up. It went up. It stopped dropping and it went higher. So that is what I meant by hook up. Okay, so the first one you see here, it drop, and then it hook up. So this is the candle. This green dash vertical bar, vertical line is highlighting the candle. This is called the candle where the hook up has been confirmed. Similarly, the second time that this hookup has happened is here. You can see stochastic drop below 20, and then it increased after that. And that candle, this candle that is under this vertical green dash line, is where the hookup happened. And the third one, it has happened. I know it looks very close to 20. It did drop below 20 and then it hooked up above 20. And therefore, this is also a hook up. So this hookup from below 20, above 20 is taught to me by a dear friend of mine called Ian Low. So I've learned a lot from him over the years, and in particular, this hookup method. Okay, so this is when these two conditions are met, right? We call it a swing low. Condition 1, both MACD and the signal line are below 0, and we see a hook up. So these are the 3 swing lows. All right. So don't worry if you are lost so far, because you can always review the video, okay, the recording. Now, next candle that we need to learn is the signal candle. And the signal candle is very simple. Basically, the swing lows that we've identified, right? This candle here, this candle here, and this candle here are the signal candle, right? Because they are the swing low. That's where the swing low had happened. Okay. Now, from the swing low, from the signal candle, we can then determine whether we should take an entry after the signal candle. And how do we know? Simply by looking at the subsequent candle's price, whether it has exceeded the high of the signal candle within the next 3 candles. So what do I mean by that? So let's look at the same 3 signal candles identified earlier. All right, we start from the left. So we have this signal candle. The high is up here, right? High of the signal candle. I've drawn a horizontal line so it's easier to see across the next 3 days. Now you'll see that the next 3 weeks. So you'll see that the week after the signal candle, the price of DBS did cross above the high of the signal candle. And therefore, this is what I call an entry candle. And it is at that point where it crossed that you can buy the stock, the DBS. Okay, so this is the first example. Now the second example is in the middle. The same signal candle here we identified earlier. In this week, we highlighted, I draw a horizontal line across for 3 more weeks. And you will see that the next 3 weeks, none of the candles price have exceeded the high of the signal candle. So therefore, there is no entry in the second signal candle. And for the third signal candle, well, you tell me. This is the signal candle. I draw a line to cut across 3 weeks, right? In the week following the signal candle, the price of DBS did cross above the high of the signal candle. Therefore, this is an entry candle and the price of entry is just above the high of the signal candle. All right, so that's the signal candles. Clear? Not to worry if you're seeing this for the first time, please review the recording. Okay, so I've used this mechanical concept. Just do it once a week. Look at 3 charts, whether there is a signal or not, whether there's a swing low or not. And then if there's a swing low, I draw a line and I see whether the subsequent 3 weeks it crossed above or not. If it did cross above, then that's when you buy during the week. All right. So I've done the same method on the DBS stock since 2010. You'll see all the vertical lines here. They are all the entry signals, entry candles. I've done it for OCBC and I've done it for UOB. Okay, so you can see here. Now in 13 years, we have on average about 14 to 18 entries only. So it's not many, maybe 1 to 2 a year per bank. So that's very low frequency trade. Okay, so even if you are very, very busy, I think this is you gotta do a bit of homework. Okay. All right, so let me move on. Now, how about potential exits, right? So technically, when we want to collect dividends, we want to buy and hold for as long as possible, right? Unless that you may want to consider exit if the company's fundamental have worsened, or you have better use for the fund, or if you want to do some rebalancing of your portfolio, because you should not just only have banks as your dividend portfolio. You should also have other assets classes, such as the ones that I'll be sharing later as well. All right, so these are the potential exits. Otherwise, it's buy and hold for as long as possible so that you can be collecting regular income, regular passive income from your dividends. Right, so that's with that, I've covered how to identify swing lows, the signal candle, entry candles. And we'll move on how to build a dividend portfolio. So don't worry if you're lost, watch the recording. Okay, so here is where I will share with you how I would be building a diversified dividend portfolio. Remember, Singapore banks should only be a small part of your diversified dividend portfolio. You should never put all your egg into one basket. Don't take all your net worth and buy only DBS. You should never do that, right? So as Harry Markowitz, the 1952 Nobel Prize economic winner, he said, diversification is the only free lunch in finance. Okay, this is the best way I know how to manage risks. So how to diversify? If you want to have an income portfolio, you can have Syfe REIT Plus, you can have Singapore banks, you can have dividend stocks, you can have Syfe Cash, you can have T-bills, and you can have SSB. right? So that you can diversify your portfolio. And then with Syfe having a new product coming out for their yield income product in the next few weeks, I'm excited to add another tile here for that. Okay, so now I'll be sharing with you two models that are for your reference on how to build a Singapore bank's portfolio, dividend portfolio, right? So for each of the candle, for each of the entry candle, the two models are the following. The first model, model 1, is to buy a fixed number of shares each time the entry candle is triggered. Okay, buy a fixed number of shares. And for Singapore stocks, the minimum you can buy is 100 shares. We don't have fractional shares here in Singapore, not yet. So I'm using this as a model to build. And this is probably suitable for people who are just starting out and they are a little bit fearful, but they still want to benefit from some passive income from the dividends by the bank. So then you can consider starting small. So the smallest you can buy is 100 shares, right? Fixed number of shares. That's for model 1. For model 2 is for people who wants to have a bigger budget and they are willing to commit a fixed amount each time that the entry candle is triggered, right? So the example I've used is 10,000. So you can adjust this to 50,000, 100,000 or 5,000 depending on your budget. But in the illustration today, I'll be using 10,000. So for the model 1, just to let you have an example, 100 shares of DBS, share price being $33 times 100 each time you buy will be $3,300. For OCBC Bank, the stock price as of 31st of March was 12.37. So times 100 each time you buy, if you were to buy 100 shares, it'll be $1,237. And likewise for UOB, 29.76 times 100 is $2,900. So you need to have that budget ready if you want to invest in banks, right? So if you say that, oh, Richard, I only got $2,000, then how? Then you can only buy one, no? OCBC, right? So if you say that, oh, okay, I have 10K, so maybe I buy all, sure, because it's well under 10K, buy 100 shares each, right? So for model 2 is where we buy up to 10K worth of the stock. So you can see here for the DBS, $33, if you have 10K budget, you can buy 300 shares. And that won't give you 10K. That will only give you 9,900 because we have to buy in multiples of 100. Similarly for OCBC, $12.37, we can buy 800 shares and that comes up to $9,800. And for UOB, it's $29.76. We can buy 300 shares and that comes up to $8,900, not exactly 10,000, okay? But you understand what I mean. So these are the two models that I'll be using to share with you what is the result. If you had invested this way using model 1 since 2010 and using model 2 since 2010, then what would be the cost, your cost of how much you have put into the investment, as well as what would be your yield on cost. Remember, that is my favorite metric. Yeah, yield on cost. If you had been investing this way since 2010, about 12, 13 years already. Okay, so get ready for lots and lots of numbers. Okay. Now, just to refresh your memory, these are all the entry candles for DBS since 2010. This one for OCBC and this one for UOB. And I've compiled into this table all the dates that the entry candle is and the price of entry, right? From all the vertical bars that you see earlier. So these three tables is a summary of that. And you can see that using that mechanical method of identifying swing lows, signal candles, and entry candles, it managed to catch the COVID low. Right, 23rd of March 2020, 23rd of March 2020, and here don't have, not for UOB. All right, so let me now move on. So this report card, remember? So I just want you to pay attention to the current yield, which is 4.5%, 5.5%, and 4.5%. This will be your yield, your current yield, if you will have bought the banks on 31st of March. Now, what about the yield on cost? That's where the lots of numbers come in. So not to worry, I'll break it down for you, right? So in these tables, you're seeing on the right-hand side is the cost. That's your cost. And across each year, how much would you have invested into each of the banks? So you can see here, 2010, because of the entry candles, you would have invested this amount, 1442 into DBS, 0 for OCBC, and 3007 for UOB. And for the whole year, about $5,000, right? So for that year, you have no yield on cost because you have not collected dividend. So the left-hand side here is the dividend that you would have collected that year if you had made that investment. All right. So in a similar way, I have compiled the cost on the rest of the years, as you can see here, for the cost as well as the dividend that you'll be collecting. And you can see that your dividend are growing because you are accumulating more and more shares and you're not selling, right? So cumulatively, then there will be the cumulative cost, right? That will be how much your portfolio is growing, the amount that you have been spending. And based on the dividend that you get that year for each of the banks, right? On a collective basis, that is your yield on cost if you have bought all three banks, right? And you can also see that generally it has been growing if you have bought all three banks. What if you have only bought a single bank? And that means for the last 12 years, you only buy DBS. Then we only look at here, right? Your yield on cost, YOC, is 7.64. You would have invested over 12, 13 years, 25,000. Then similarly, the yield on cost for OCBC would be 5.61%, and you would have invested 19,000. And likewise for UOB, 5.06%, and you would have invested 34,000. And collectively, if you have invested in all three banks, you would have invested a total of 79,000. Okay, so that's how to look at this table. Now, beyond the yield, we can also look at our bonus, right? So what would be the bonus? Firstly, the capital gain. Over the years, you've been buying DBS, your average cost is only $18, right? This column is for DBS. So your yield on cost 7.64, and your average cost across the 14 times that you buy DBS is $18. But based on 31st of March, the price of DBS is $33. So there is a capital gain. And remember, this capital gain is tax-free for, generally speaking, for Singaporeans, right? So is the dividend. So it's very nice. Okay, so you, over the 13 years, you would have bought 1,400 shares, right? So this will be worth about 46,000, but you only put in 25,000. So your capital gain is 81%, almost double your money already, purely from the capital appreciation, stock price movement. Okay, so in addition to this capital gain that you're sitting on, you are sitting on $10,700 worth of dividend they have collected over the years. Okay, so if you have put in 25,000 and you have collected 10,000 of dividend, is every time you collect a dividend, you're reducing your capital at risk. So the capital at risk by this time is only 14,000. Okay, so I've explained in greater detail for DBS because I won't explain for OCBC and UOB. They are just done in a similar manner. Right? So this is for Model 1. Now remember, the current yield for DBS was what? 4.5%, right? But if you had, that is if you were to buy DBS like now. But if you had invested consistently over the years since 2010, your yield on cost would be 7.64%, higher. Okay, higher than the current yield. Now for Model 2, in a similar way, remember Model 1 is where we buy the minimum that we can, 100 shares of each bank. For Model 2, we are talking about buying fixed amount for each bank. And in a similar way, I've compiled the data into the cost, how much it would have cost you for that bank that you invest for each of the years, and how much dividend you have collected, and what would be your yield on cost on the last column you see here. So I won't go into detail. You can pause the video to examine the numbers yourself. Okay, and likewise, we have the yield on cost at the bottom. And you can see that for DBS itself, the yield on cost is even higher than Model 1. Model 1 was 7% plus, for Model 2 is 8% plus. Okay, so likewise, beyond the yield, you're sitting on a higher capital gain compared to model 1. Okay, and therefore your capital at risk has also reduced. But because you're using $10,000 per time that you invest, of course, the total capital outlay is higher. So it depends on your budget. All right. So comparing the two models, right? In the left, we have model 1. On the right, we have model 2. So you can see that using this way of consistently accumulating Singapore bank shares whenever there is a swing low, whenever there is a crisis, okay, you are able to build up a dividend portfolio that can give you passive income where the yield on cost is higher than the current yield. And the two models I've shared here, which one is better? Well, a lot depends on your own risk appetite and your own budget. Okay, so this is not where you need to monitor price every day. 1 year, you maybe only need to buy one time or 3 times. Okay, so sometimes for some years, you don't even buy anything. So it's really, in a way, buy and forget. Okay, so this is the yield on cost. So this is what I want to leave you with in terms of how to these two model portfolios that can be used for your reference to construct a dividend portfolio. All right, so with that, I have covered the agenda for today. And if any of the topics that I've gone too fast, please feel free to review the recording. And if you have benefited from this video, please like, subscribe, and share Syfe YouTube as well as WealthEnjoy YouTube. And it is my hope that this webinar has inspired you to study further about dividend investing, about Singapore banks, and build your own models so that with that model, you can build your own dividend portfolio. All right. So if you'd like to follow what I do and other webinars that I'll be conducting, please remember to join WealthEnjoy Telegram channel so that you can be kept posted. And with that, I'd like to hand the stage back to Sam. And thank you for your time.
Thanks very much, Richard, and very, very interesting insights you shared there, both on the fundamental side and the technical side of how to invest in Singapore banks. But of course, you can port this to other stocks and sectors as well, right? So just on our side, just a quick implementation of how some of this could work within the brokerage app, and some of the tools we have to help essentially you action some of these very interesting insights that Richard has shared, right? So if I go back to what the slide I showed in the beginning in terms of the various options that you can have when you're trying to build a passive income portfolio, right? We obviously talked now extensively about Singapore banks, and you can see the yield there. And again, as Richard mentioned, this is on a trailing 12-month basis, which is currently 4.9% for Singapore banks, right? And I think there was a question around, well, how often does this yield number change? So I can perhaps answer that right now. And this yield number would be, as Richard described, impacted by 2 variables, right? So one would be the price. So in essence, this yield number can change when you talk about single stocks, particularly, well, every second in terms of when the market is open and the price moves, the higher the price is, the lower the yield that you will receive, right? And likewise, the lower the price is, the higher the yield that you will receive. Secondly, it moves by the actual dividend that the company pays, and that again would be most likely on a quarterly and sometimes on a semi-annual basis, right? So it can also move depending on the fundamentals of the company, the cash flows that it generates, and therefore how much dividend it is able to pay out to its shareholders. So I hope that answers that question. And of course, as we can see here, how you construct an overall passive income solution that is right for you depends on your risk tolerance. So if you're at the lower end of the spectrum and you want a more stable yield, something like a cash plus would be suitable for you. And at the other end of the spectrum, if you do want to have more access to capital appreciation potential as well, and have a strong view on whether it's, you know, properties. REIT could be a good product for you, and, you know, likewise, if you have a strong view on Singapore banks as another example, you know, that could be a good implementation for you to build a portfolio on Singapore banks, right? And of course, again, soon to becoming another option for us in the next 2 weeks, as Richard mentioned as well. And if I move to essentially some of the ways in which the last portion we talked about in terms of Singapore banks, and you could action some of the you know, methods that Richard was talking about. You could find dividend stocks through our discovery list. So we have, you know, a section on the discovery list, a theme on the discovery list, which just covers high dividend stocks and the highest dividend stocks that are available, and whether it's US markets or Singapore markets, whichever you prefer. And this would screen for you immediately which are the stocks with the highest dividend yields. Or if you have a specific sector in mind, such as Singapore banks, you could go to sectors and finance and select from there the Singapore bank stocks, DBS, UOB, and OCBC that Richard was speaking about today. And akin to what, you know, we at Syfe talk about a lot in terms of being, you know, disciplined with your investing, and in terms of, you know, building this passive income portfolio in a very, should I say, you know, maybe a stable and disciplined fashion. Dollar cost averaging is a very good way in which to do this, right? So as Richard, you know, mentioned, of course, you know, the ideal is obviously buying at the low, but if, you know, perhaps you don't have time in which to really pay attention to when stocks, you know, are at lows or highs, you can just buy on a regular basis through whether it's weekly, bi-weekly, and monthly, and that can be automatically done for you on our Syfe app. And the other interesting thing, and this is actually was something that I really thought about a lot when Richard was talking about yield on cost, right? And when we talk about yield on cost in terms of, okay, maybe you had a set dividend yield in mind for any particular stock. So you want a DBS, you said, okay, I only want a 5% dividend yield in DBS. And as we said, there is two variables to that, right? The dividend that gets paid and the price of the stock. So if you are only buying at the price of the stock that you essentially have said, okay, you know, this is what it gives me at the current yield of 5%, you can set an alert based off either the market price, so a specific target price in terms of the stock price, or you can actually base this off what you've already calculated in terms of your average cost and entry price of DBS, and say that, okay, look, anytime it goes to this level or below this level, that is when I want to be alerted to buy the stock. So again, you know, another way to make you very disciplined about your investing, and essentially, you know, be able to stick to potential yields that you have in mind for the stocks that you buy. So this is just some examples on our app. So obviously, you know, setting a market price or setting an average cost price based alert, as I mentioned previously. On pricing, right? So for perhaps, again, for those people who maybe are less familiar with our Syfe app, we have on the trade platform, no account minimums, no inactivity fees. For the US market is simple pricing of, well, first, for the first 3 months, unlimited free trades. After 3 months, 2 free trades a month, and $149 per trade thereafter. To action the Singapore bank stocks that Richard mentioned for SGX, we have a 6 basis point cost of traded value, or a minimum of $1.98 Singapore dollars. Okay, We do have a promo for this, for anybody who's joining in this webinar, and you can enter trade 20 in the Syfe app or scan the QR code for your convenience. I think we have a bunch of questions, and I know we don't have much time, so I'm going to hand it over to Richaard and see which one of those we can answer, because we've already gone a little bit over time.
Okay, no problem. So I just click on the Q&A box.
Yes. Perhaps Richaard, I'll just chime in over here. In the interest of time, maybe let me just filter a few, I would say, prominent questions, right,
Sure.
that I think would be good for all of us here to understand further, right? And I think the first question perhaps is in terms of choosing a good dividend stock or even building up a good dividend portfolio. Other than looking at the yield on cost, are there any other factors that we should look at, like for example, price to book value, right? Is that a possible factor that we could look at, right, in terms of choosing a good dividend stock?
Well, there's a lot of religion there. The answer is going to be very long. So I would like to say that I like to choose simple business models, right? So that's why I choose banks. So banks is the 4 metrics that you see that Syfe has already covered. I also love REITs because REITs is just landlord business, right? Collect rent, pay unit holders. So these are the 2 best asset classes for dividend stocks. So beyond these, the kind of stocks that I like are typical great business that generate recurring passive income. Like for example, Viacom, right? Viacom, which I also own as a dividend stock, right? What do? They examine, they inspect vehicles in Singapore. So there's no way that any vehicle can go on the road without being inspected. So there will surely be a guaranteed revenue for the shareholders of Viacom. So which factor to look at will depend a lot on the type of business that you're looking at. So I can't say price to book is the only factor across all the kind of dividend stocks. So I can't pinpoint a specific factor. So I would say start with the simplest. Start with Syfe Cash Plus. Then go on to Syfe REIT Plus, right? All these are no-brainers that Syfe do it for you already. Then if you have time, you want to go and learn, then start learning. Okay, Singapore banks, because there are only 3. If you only choose one, the one is very clear one, the top student, right? Among the class of 3, right? So if you have graduated from investing in Singapore banks, then you can move on to secondary school. Then that's when you'll examine REITs. Okay.
All right, Richaard, thanks for that. I think we'll all depart this session thinking about class of 3, who's the best student. All right. Sam, maybe one last quick question because we've overran already, and I think one of the viewers was asking, is there a financial or rather an ETF that they can actually invest into to actually go into the financials rather than just trying to identify individual banks?
So, not to my recollection, is there one for Singapore? Richaard can probably correct me if I'm wrong. Don't have, right? Yeah, that's what I thought. But there would be, if you're talking about, US or global banks, and we can certainly, get back to you on those specific ETFs, right? But not for Singapore, banks.
All right, thanks a lot, Sam. So before I hand the time to Sam and Richaard for just one last quick sign off, right? There are a lot of questions with regards to like technical skills, like for example MACD, stochastics, right? Asking questions about like the candles. And I think if you want to know more about this, then obviously this is a good segue for me to pass the time to Richaard for you to have a last sign off.
Okay, now on the technical questions about the charts, please look at the previous webinar that I've done with Sam on simple technical analysis for long-term stock investing, that you can look for it on the Syfe YouTube channel as well as WealthEnjoy YouTube channel. And I go into greater detail on how those indicators are used. Of course, Google is a good friend, so you should Google and learn about it there as well.
All right. Thanks, Richaard. And any last words for our viewers today?
Thanks very much, Richaard. And I think if there was also obviously a lot of questions here, both on the technical and fundamental side, and as Richaard mentioned, I think on the fundamental side we could do a webinar in on it itself in terms of I think some questions around intrinsic value and book values, etc. Right? I think the one thing that I would say there is that there are a number of ways in which to think about, an overvalued stock, an undervalued stock, right? In this context, you can think of dividend yield as one way to evaluate, is it overvalued or is it undervalued, right? Because if you are trying to invest for passive income and the yield goes to, let's say, 3-4%, for some of these stocks, where actually there are other options out there, and even a cash plus option which potentially gives you a higher yield. That is one way to think about overvalued and undervalued potentially, right? And of course, when you think about it more on a fundamental basis, then it does require quite a lot of work. And typically, the way that people would think about this is in terms of discounted cash flows, etc. And I don't want to go too much into detail on that. But another simple way to look at this is, okay, where are they trading relative to the past, right? And the return profile that they have at the moment. And actually, on the app, we do have and show relative PE, historical Ps. If you go to the analysis tab, and you can see, is this stock trading very high compared to its past, very low compared to its past, etc. And you can look at the return profile, ROEs, etc., to see, does that kind of make sense to you, right? One other way is in which you could do that is, typically, analysts and in equity research houses and sell side banks would derive their target prices based on their analysis of what the intrinsic value and the fair value of a stock is. And you can see, where the stock is trading relative to the various target prices of the analysts. Of course, there is some subjectivity here. You can put different growth assumptions depending on how bullish or bearish you are on a particular company or stock. But that's some ways in which you can get started, with thinking about value. Okay, I think we have gone quite a bit over, but as always, Richaard, a great pleasure to have you with us today. And Jason, thank you for your moderation as well. And thank you for everybody this evening who has joined us. I hope you have gotten some valuable insights, and again, stay tuned for our next webinar, which will be an exciting one, launching our new income product within the next couple of weeks. Good night, everybody.
Thanks, everyone. Thanks, Richaard. Thanks, Sam. Good night.